Good evening. Welcome to our Economic Outlook Conference. My name is Alice Simon. I'm a member of the Economics Department, and I'm also the Faculty Director of the Voltimati Center. We are extremely excited to have you with us this evening. We have three wonderful panelists. Dr. Goran Skospels will be moderating. And before we begin, I would like to welcome members of the Ohio Wesleyan student community, faculty community, alumni community, business community. And this is being videotaped and will be streamed so that members of our alumni community can view it as well. We welcome you and thank you, and it is our pleasure to introduce right now our president, Dr. Rock Jones.
Thank you, Alice. Good evening. It's good to see all of you. Welcome to this annual Economic Outlook Conference, one of the many programs sponsored throughout each academic year by the Voltimati Center for Economics, Business, and Entrepreneurship. Dr. Simon is the director of that center, which was first formed in 1985, I believe, and provides our students with a number of opportunities to connect their classroom learning with practical real-world experiences, including internships and externships and opportunities to interact with members of the business community, both locally and in other parts of the country, and in some cases even in other parts of the world. The Voltimati Center also hosts a number of programs throughout the year, like this one, that bring together our students and faculty as well as members of the community. And I too want to welcome those of you from beyond the walls of the Ohio Wesleyan campus who are a part of this evening. And I hope that if you are not a regular participant in Voltimati Center activities, that you will make plans to do so. The activities each year include the Milligan Leaders in Business Lectureship. This year's lecture happened just a few weeks ago with Tracy Winbigler, the Chief Operating Officer of the National Geographic Society and a longtime executive with General Electric, a member of the Ohio Wesleyan class of 1987. As this year's speaker, the annual Heisler Business Ethics Lecture is a part of the Voltimati Center, and a new lecture series that looks at issues related to environmental economics. Tonight we gather, as we do each year, to peer into the looking glass through the eyes of some experts and who can help us imagine what may be ahead for us in our economy. It's always interesting and it always seems to be current and contemporary and relevant. You know the volatility in the markets that we're experiencing. You know that unemployment is down. You're probably wondering, as I am, will interest rates rise and will inflation follow? And maybe they'll give us a hint into some of those, the answers to those and other questions. It's a pleasure to welcome all of you this evening, and also my pleasure to formally introduce the moderator of the panel, a member of our faculty, the Robert and Mary Cook Milligan Professor of Economics, Dr. Goran Skospels. Goran's teaching focus includes economics of transition, macroeconomics, developmental economics, international economics, research methods, and economics principles. His research deals with institutional changes in post-communist countries of Eastern Europe and the former Soviet Union, in banking and credit, and in business finance. He teaches courses in the principles of economics, in national income and business cycles, research methods in economics, and economic systems. Goran, thank you as always for your leadership as the moderator, and we look forward to the panel.
Welcome this evening. I am also looking forward to hearing what our experts have to say, and as always, we have three fascinating individuals who are going to share some ideas about the economy. So we typically split the conference into three perspectives. One is an international perspective, and this year this is going to be provided by Dr. Ian Sheldon, who is an Anderson Professor of International Trade in the Department of Agricultural, Environmental, and Development Economics at The Ohio State University. He got his training in the UK and was teaching at the Exeter University before coming to Ohio State, and he is a professor in the Agriculture Economics Department over there. And I learned that he's also an editor in Applied Economic Perspectives and Policy, which I assume takes significant chunk of his time. The second perspective is a national perspective, and typically that is provided during this conference by somebody from the Cleveland Federal Reserve Bank. And this year, we are pleased to have Joel Elvery, Dr. Joel Elvery, who is going to give us the national outlook. So maybe we'll hear a lot about unemployment, interest rates, GDP, and so on. All the good stuff. Joel's primary fields are labor, public and urban economics, and he joined the Federal Reserve Bank in 2013. Before that, he was an assistant professor at the Maxine Goodman Levin College of Urban Affairs at the Cleveland State University. And he got his PhD in economics from the University of Maryland. The third perspective is local or regional perspective. And this year we are pleased to have Bill Lafayette, who's been a member of the panel several years running, and we are always glad to have him back. He is a founder of Regionomics, which he founded in 2011, which is a consulting business offering an array of strategic, economic, and workforce analysis. Bill shared with me, for instance, that he has been doing some work on figuring out how getting physically disabled individuals back into the workforce and how this is beneficial for business, what the impact of that is, and he's going to give a presentation on that in Cleveland later this week. Friday. So very current policy-oriented things that Regionomics is doing. Bill earned a PhD in real estate economics from the Ohio State University, and he also holds an MBA in investment management and in finance and accounting from Wright State University. We're going to have each one of our panelists give about 10 to 12-minute presentation, and then I'll ask them to ask each other some questions, and then we'll open it up to the audience if the audience has some questions. Without any delay, let's have Ian Sheldon. Ian?
Okay, thanks. Let me just go back one slide here. Okay, I'm going to try and stick to the 12-minute time limit, so make sure you tell me when I have 2 minutes to go. So I'm going to give a very quick talk here. I've entitled this A Global Economic Outlook. I'm actually only going to give a very short discussion of where we currently think GDP and inflation are globally, and then I'm going to talk about the downside risks, and in particular I'm going to talk about what Larry Summers has recently called the risk of secular stagnation, and I hope this might set up my friend over here from the Cleveland Fed and others, because I'm going to say some things with respect to policy that may not be the most popular things that are being said right now in macroeconomics. So let me start with saying something about global economic growth. Well, world output is forecast to grow by 3.8% in 2015, and growth is expected to strengthen across the advanced economies. But the pace of recovery in the advanced economies is quite different across the various regions. It's a lot stronger in the US. It's very weak in the euro area. It looks like the eurozone area is suffering from eurosclerosis, again, as it was described back in the 80s and 90s. Very modest growth in Japan. If you know anything about Japan, you know it went through a lost decade in the 90s and has struggled considerably since. And we expect solid growth in my home country of the UK and north of the border up in Canada. In the emerging and the the developing economies, we're expecting to see fairly modest increases in economic growth. This is largely driven by the fact that in these economies, domestic demand has strengthened, and also there's been a little bit of a recovery in external demand. By that I mean the developed economies like the US, Some countries in Europe are importing more, so that's led to an increase in demand for countries in the emerging world. This is just a couple of graphics. All these data come from the IMF's, the International Monetary Fund's, October Economic Outlook. You can download all this data now. They even have interactive graphs. If you're interested, go to their website. It's a very good source of information. And essentially, you can see up here, this is what is the red line is the most current forecast. The blue line is from their previous economic outlook. And this is what we're expecting in the advanced economies, somewhere between maybe up to 3 to 2.5%. Rescaled over here, we have the emerging markets and developing economies growing at around just over 5% per annum in aggregate. So looking at the growth dynamics, so this is breaking things down just a little bit more carefully. Joel, no doubt, will talk a lot more about the US case, but these are the IMF forecasts. The US is expected to grow by just over 3%. In the next year, at least according to the IMF numbers. Maybe the Fed's numbers are a little bit different. This rebound is mostly due to accommodative monetary policy, but we're also observing, after all the deleveraging that occurred after the financial crisis, that households have rebuilt their balance sheets and are feeling much more confident. And for those of you that follow these things, we have a much healthier housing market here in the US, which Joel is sort of shaking his head. Again, different forecasters have different expectations, but the economy is expected to rebound here in the US. Japan, pretty sluggish growth, 0.8%. It's stable, though, relative to the current year of about 0.9%. This is despite the fact that Abenomics, named after the Japanese Prime Minister, is being rolled back. There's going to be a fiscal adjustment in Japan that will probably slow down their economic growth. The euro area is forecast to grow by about 1.3%, but the prospects are pretty uneven across countries in the eurozone. Italy actually has negative economic growth right now. Germany is showing signs of a weakening economy, and France is basically at a standstill, from what I can tell, if you look at the major economies in the eurozone. China, growing at 7.1%, but there's an expectation that residential investment is going to lead to a slowdown or a modest decline in the Chinese economy. I'd like to say some remarks later on about China. Latin America, relatively modest growth rates, 2.2%, largely because of deteriorating terms of trade. That's largely due to exchange rate movements, particularly Brazil, and also to some extent Mexico, and idiosyncratic, very much country-specific reasons in countries like Brazil and Mexico. On the inflation side, inflation is really very low in the advanced economies. If you go to the next slide here, you can see the advanced economies here down in blue forecast to be less than 2% inflation. And if you think most central banks are targeting about 2% as the target, we're pretty close to that target right now. But it varies. In inflation is low in advanced economies. Why? We still have very large output gaps. And I'm going to say something in a minute about output gaps. And deflation, or at least the long period of very low rates of inflation, is really very much of a concern, particularly in the Eurozone area. As for the major economies, again, the forecast from the IMF may differ from the Fed's forecast, about 2% here in the US. We're hitting target. The euro area is considerably below target at 0.9%, maybe even will go lower. Japan hitting 2% target, whereas the emerging and developing economies have much higher rates of inflation. So what are the downside risks? And this is, if you read the IMF reports carefully, this is what led me into reading and thinking about secular stagnation. The short-term risks. The short-term risks are geopolitical. I assume you follow the news. What's happening in the Middle East with ISIS, etc., is one reason. Obviously, it could affect oil prices. But also what's happening in Ukraine and Russia. I read in the newspaper today that NATO had spotted armored vehicles crossing the border into eastern Ukraine. Apparently, by the end of the day, they'd left again, but there's still uncertainty in that part of the world. Monetary policy normalization in the US, this is the ratcheting down of quantitative easing, may have spillover effects into the rest of the world. Obviously, it's had an effect, at least in the short run, we had some volatility in the stock market, which may have been a result of announcements by the chairman of the Fed, Janet Yellen. And there's real concerns about the potential for deflation in the Eurozone. But I think it's the medium-term risks that I'm most interested in talking about. The second one is the easiest one to talk about. There's an expectation that China may have a very hard landing if it doesn't rebalance its economic growth path. And in particular here, if you read The Economist magazine, there was a very good short editorial on Chinese debt 2 weeks ago. When I first started studying China, there was very little public debt in China. Public debt has increased largely as a result of their fiscal stimulus in 2008, 2009. A lot of that stimulus went into the old state-owned enterprises, and there are potentially a lot of non-performing loans on their balance sheets of the banks. The only upside in China is most of the banks, the Chinese government has an iron fist over the banking system and may be able to deal with this rather quickly. But there's a real concern that China's economic growth may not nosedive, but there may be some kind of hard landing. What's really interesting, I think, and the IMF talks about this, and in fact it was Larry Summers who reintroduced this language of secular stagnation into the macroeconomics debate. He gave a talk in 2013, and he gave a talk earlier this year to the IMF. And if you're interested, there's a Vox EU 150-page book that just got published on the internet this week by Richard Baldwin that goes through this whole issue. So secular stagnation, this was Hansen used this language in his 1938 speech to the American Economic Association. Now, we got it wrong because the Second World War came along, and we came out of the Great Depression. There wasn't secular stagnation. But this language has come back into vogue because we're witnessing the potential. We have low growth potential. I'm going to show you some evidence to support that argument, and the possibility that this is going to result in what's called secular stagnation, particularly in the advanced economies. And I'm going to say at the very end that I think this is more of a risk for Europe than it is for the United States, but maybe we could discuss that in the panel. So very quickly, secular stagnation. So why haven't the advanced economies then returned to their pre-crisis growth rates when we've had near zero interest rates, for 6 years or so, here in both Europe and in the United States? So the potential growth rate may have fallen. Why? Because of a slowdown in the growth of productive inputs. That's a demographic issue. And also because maybe there's a slowdown in technological progress. And Robert Gordon has a great chapter on that in this book that I just mentioned. We also have persistent output gaps. That's the gap between potential GDP growth and actual GDP growth. We have very weak demand, private demand, both here in Europe and in the US. And these ideas are particularly being pushed by Larry Summers and Paul Krugman. And again, they both have chapters in that book that I just mentioned. Thirdly, there may be damage to potential output because unemployment, long periods of unemployment, has resulted in depreciation of human capital and what Ed Glazier at Harvard calls loss of talent. So some of that potential for economic growth has declined because people have been unemployed for a long period. So here's a couple of graphics for you. This is actual GDP growth here in the US. And you'll notice that this is the pre-crisis 2007. This was potential GDP. We had virtually no output gap. Then we get the crash here. Notice what's happening is the estimated potential GDP growth rates are being continuously brought down. That's that decline in potential growth, and we still have a large output gap. And that's the idea that savings outweighs investment. We have low private demand. Similar diagram here for the Eurozone. Okay, so ratcheting down of forecast potential growth rates and still pretty large output gaps. And the gap's larger here in Europe than it is in the US. And Larry Summers actually has another great graph to show that where the EU is looks very similar to where Japan was in the 1990s. So what are the implications of secular stagnation? Well, negative real interest rate. So the real interest rate is the nominal rate minus the rate of inflation. Okay, so the argument is that maybe we'll need negative real interest rates to equate savings investment at the full employment level. In other words, we need negative real interest rates to boost investment and depress or discourage savings if we believe that we have a surplus of savings over investment. And the argument is it's harder to achieve full employment with low inflation and a zero lower bound on policy interest rates. Joel can talk about where we are on the zero lower bound. By that I mean the Fed can't lower the rate below zero. So you need to get a negative real interest rate, you need some inflation in order to get a real interest rate that drops below zero. And unfortunately, if you have deflation, and this is the risk that Europe faces, if you have deflation, right, prices are falling, subtract a negative number, right, from the nominal rate, and you can only get a positive number. And so that's the problem with deflation, is you can't get a negative real interest rate. So the argument is it may be difficult to achieve full employment, a satisfactory rate of growth, and financial stability through conventional monetary policy. So what's happened to real interest rates very quickly? So interest rates actually have went negative, here's the recession kicking in here, negative real interest rates in the US, negative real interest rates over here in the Eurozone. But importantly, you've seen this long-run trend downwards in the real interest rate, both in the US and in the Eurozone. So do low real interest rates matter? Well, if real rates are low in normal times, when you have an adverse shock, you will need a negative real rate in order to restore full employment. But, and this is the point that Larry Summers makes, the problem with low real interest rates is they undermine financial stability. Why? Investors start taking more risks as they seek yield. If you're thinking about bonds, you have to pay coupons on those bonds. If interest rates are really low, you get irresponsible lending because the coupon rate's really low. And importantly, you get this risk of Ponzi schemes. So Ponzi schemes are schemes where the person running the scheme promises you a much better rate of return than the official rates of return that you can get elsewhere in the market. Okay? So the real interest rate required to restore full employment may actually be inconsistent with financial stability. So even though we might need a negative real rate in order to deal with unemployment, restore the balance between investment and savings and get back to full employment, you run the risk of financial instability. And that's the piece of the story that I think Summers is adding. Now, I'm going to appeal here to Monty Python. If you know your Monty Python, the old dead parrot sketch, I asked the question, is the parrot just resting or is it really sick? And if you read The Economist, you know this is from the front page of The Economist a few weeks ago. You remember John Cleese asks Michael Palin in the pet store, he says, this parrot is dead. It's not dead, it's just paining for its Norwegian fjord. So is the parrot really sick? Well, if the US is expected to have a steady state rate of growth of about 2% per annum, which is what we had before the recession for a period of 10, 15 years on average, it's not really obvious that the US is going to suffer a permanent shortfall in demand or require a permanent negative real interest rate. In other words, it's hypochondria here in the US, this concern about secular stagnation. The American economy is probably stronger than the Eurozone. But the Eurozone may well be really sick. The parrot really is dead and lying on the floor of the cage. Okay? And John Cleese would be quite legitimate in asking for his money back. Secular stagnation, Nick Crafts, he's an economic historian in the UK, would argue is much more real. Why? Less favorable demographics in terms of an aging population, retirement ages and so on, much lower productivity growth than here in the US, a much higher burden of fiscal consolidation if you understand what happened in the Euro crisis, and the European Central Bank has a very strict focus on low inflation, is not going to allow the target inflation rate to go any higher than 2%. At least Draghi has his hands tied behind his back mostly by, I hesitate to say this, but I think the Germans. So finally, what does that mean for policy choices? And I'm hoping this slide gets my colleague Doug Southgate going. This was the intention, and hopefully provokes my fellow panelists. If you believe in the secular stagnation story, this is a challenge to the recent macroeconomic policy consensus, where we target inflation at 2%, we manage fiscal deficits, and we keep down the debt. And we maybe use monetary policy to target the unemployment rate when it gets really out of whack. So what are the policy choices? Well, on the monetary policy side, maybe you need to relax those target rates, and they're talking about raising it to 4%. If you raise it to 4%, it's easier if you're at the lower bound with nominal rates to get a real negative rate of interest and maybe restore unemployment. Alternatively, you can go on the fiscal side, and that's where this is a very sort of neo-Keynesian type of debate going on. Krugman's writing about it repeatedly in his New York Times column, but I think Larry Summers, Richard Baldwin, and others present a pretty compelling argument about where you would target. Invest in physical infrastructure, and we hear that debate about the US all the time. Simplify procedures for business startups. The idea here is to increase investment. So that's the investment side of the aggregate demand story. On the savings side, we need to maintain social safety nets in order to preserve or maintain spending on the part of those on lower incomes. And the bit that's probably the most controversial, and if you read Thomas Piketty and others, I guess he would buy into this kind of argument, and Larry Summers argues this in his most recent work, with redistribution of income towards the upper end of the income distribution, the argument is you're putting money in the pockets of people with low propensity to consume. So the argument is redistribute income to those further down the income distribution who have a higher propensity to spend, you raise aggregate demand, you restore the investment savings balance. So that's where I'm going to finish. I'm sure I went slightly over time, but I spoke as fast as I could. Thanks very much.
Thank you. Right, that's what we said.
You're third, right?
I'm third.
Yes.
That's why I script myself.
All right, thank you very much. I'm Joel Elvery from the Federal Reserve Bank of Cleveland, and I'm going to focus on the U.S. economy, both looking at sort of what have we experienced over the last year and what do we anticipate for next year and a little bit more forward. So it is my duty as a Federal Reserve employee to tell you that the views expressed here are my own and not those of the Federal Reserve System or my bosses in DC. Okay. So we like to focus on GDP. Aside from one quarter, GDP growth has been relatively strong since the third quarter of 2013. So we're looking at over a year now of relatively strong GDP growth, except for that first quarter of 2014. You might remember it. It was really cold. There was a lot of snow. That's sort of our take on what happened with that quarter. So when I say relatively strong, we're talking about over 3%, which if we go back 20 years, that's not great. But if we go back over recent years, that's actually a pretty strong GDP growth. Then, you know, the inflation is also very important to us. So inflation remains below the Federal Reserve's target of about 2%. The Federal Reserve mostly focuses on the personal consumption and expenditure measure of inflation, and that's at about 1.75 now and has been for a while. So we're still seeing low inflation. The unemployment rate has been dropping sort of steadily and reasonably quickly. In some regions, we saw very steep drops in 2014. This graph, I'm showing you two different inflation rates. The one we focus on is the official unemployment rate, but people often ask about sort of what about the more comprehensive picture that includes people who are marginally attached or working part-time. One of the reasons we feel comfortable focusing on the official unemployment rate is, as you can see, the trends are very similar between the two. If anything, the more inclusive unemployment rate is falling at about the same rate and perhaps a little faster than the official unemployment rate. So, of course, one of the reasons it's falling so fast is that we're seeing steady drops in labor force participation rate. And I actually want to give a plug for the research of one of my colleagues at the Cleveland Federal Reserve, Bruce Follick. And they're basically trying to parse out what portion of this decline in labor force participation rate is due to the business cycle. We had this severe recession, it's discouraged people from being in the labor force, versus what's just what we would anticipate based off of long-term trends in declining labor force participation rates, as well as demographic trends. And the conclusion is that most of the drop we've seen over this period is just the long-term trend. It's the structural change and not the cyclical change. Something like a quarter of the drop is due to this cyclicality. Why is that important? It has really important implications for our potential for GDP growth over the future. It also tells us something about this drop in unemployment rate. If this drop of unemployment rate is coming from people permanently exiting labor force who aren't going to come back as the economy gets stronger, then we can believe this unemployment rate of about 5.8%. If it's a bunch of people we anticipate as the economy gets stronger, people will re-enter the market and push unemployment rate back up, that has different implications. But the research we've seen so far suggests that these are really permanent declines in labor force participation rate, mostly coming from demographic changes as well as long-term trends in labor force participation rate. When we look back at 2014, where are we seeing changes? One of the things we really saw change in 2014 is the hiring rate has picked up, as well as has the job openings rate. This is translated into more payroll employment. So from the start of 2014 until October, the average monthly gain in jobs was seasonally adjusted 229,000. And that's the most sustained and robust jobs growth we've seen since the recession occurred. So we're seeing, good numbers on the number of jobs, and that shows up in the hiring rates as well as the job openings rates. So most of the labor market indicators are strong. As Ian mentioned, wage growth is not so strong. So we're still seeing wage growth being relatively weak. You'll see a little tick up just this year in the employment compensation index, which tries to be sort of a nice index measure of wage growth. It's really difficult to talk about wage growth when the composition of the workforce is changing. So if you have a recession and a lot of low-skilled workers and manufacturing workers lose their jobs, it sort of shifts the composition of what's in the wage number. And then as the economy recovers again, it's shifting back, and it's kind of hard to talk about those movements, which is one of the advantages of the employment compensation index, is it tries to design sort of a nice stable bundle of workers. But still, historically, it's low. It's essentially at inflation rate. So there's no real wage growth there. So what's the Federal Reserve doing? Well, we're still keeping inflation rates at essentially zero. And we're still seeing historically low treasury rates. So long-term debt is still historically low. And the interest on long-term debt is still historically low. So we're keeping a monetary policy accommodative. However, we have dialed back on quantitative easing. So we announced in the most recent FOMC announcement that we're going to end the bond buying program that we've been using to interject, sort of put more cash in the economy. So another sort of big trend has been the deleveraging of household debt, but really that deleveraging has been in mortgage debt. There's been a little bit of deleveraging in credit card debt and a growth in student loan debt that sort of offset each other. Most of the decline has been in mortgage debt, and while we think of that as deleveraging, it's also a lot of sort of a combination of foreclosures and then as people refinanced and were able to pull equity out with the historically low interest rates, that's pulled mortgages down. So I'm not sure how much I buy that it's households actively deleveraging versus just the substantial drop in the housing market has reduced mortgage debt. So labor market looks pretty good, GDP looks pretty good, where inflation's still sort of weaker than the Federal Reserve would like, and the other area where we see weakness is the housing market. So while housing prices have actually done pretty well so far in 2014, in terms of growing at a faster rate than they have in prior years, we're still seeing that housing construction is very slow, particularly in the single families. When we look at multifamily construction, we're actually above pre-recession levels, or essentially at the pre-recession levels in multifamily housing starts. So that's the multifamily, yay. However, right, we have this substantial drop in single-family housing starts that has really just, it's sort of steadily increasing, but still not strong. And, you know, the sense is that that single-family housing market is never going to come back to those, not in the immediate future will it come back to those pre-recession levels. We had a housing boom. There was tremendous investment in housing construction. There's still a lot of housing available from that boom. We're still sort of sorting out and absorbing that stock of housing. All right, so that was focused on the past, what happened in this last year. What can we say about where we're headed? So I'm going to share with you the forecast from the Federal Reserve Open Market Committee. These were forecasts they put together in the most recent round of forecasts in September. And what do we see? We see that in 2014, GDP growth is forecasted to be approximately 2%, or about 2.25 actually. And we expect it to grow a little bit faster in 2015 than it did in 2014, going from about 2.6 to 2.9%, somewhere in that ballpark. And then sort of stabilizing at around 2.5% going forward, between 2.25 and 2.5% going forward. Unemployment rate, we anticipate further decline, essentially at about the same rate as we saw so far in 2014, but then it'll flatten out a little bit in 2015 and then stay at about 5% in 2016 and beyond. That's what we anticipate. Inflation, we expect that it will remain below the 2% target next year, and again in 2016, and finally perhaps get up to target in 2017, which is, you know, Ian mentioned this issue of having low inflation rates makes it difficult to have a negative interest rate that would be needed for sort of strong fiscal stimulus. Well, one of the real challenges is how do you get inflation rate up when demand is weak? I mean, you have to just push so much cash into the economy. It's just a very difficult thing to imagine that. So, you know, this inflation rate is just going to creep up, but we don't have a good way to really goose it and get it to our threshold. I just included this slide so that you'd have the actual numbers that go with those graphs. And it also shows you sort of how projections changed from June to September. And essentially, if you look across all of these, you would say that the members of the Federal Open Market Committee have slightly softer view of 2015 in September than they had in June. So they're expecting less robust growth in 2015 than they had expected in June. So now I mentioned, you know, inflation rates, we'd love to get that up to our target, but that's a difficult thing to do. Well, what we can do is change the interest rate. And the majority of the members of the FOMC anticipate that interest rates will rise in 2015. So that when I say interest rates, I mean the federal funds rate, which is the overnight rate that we lend to banks, and sort of our chief instrument for controlling the interest rate. So next year we expect it to be in, you know, the sort of the midpoint of that range is about 1.25% by the end of 2015, and then creeping up slowly from there until about 3.5% long run. So you heard it here first. Expect interest rates to rise next year. So those of you who are contemplating refinancing your home, now would be a good time. Okay. So takeaways, aside from go ahead and refi, is in 2014, labor market, GDP have shown steady improvement while the housing market remains relatively weak. I didn't show housing price data. Actually, housing prices have had a good jump in 2014. But construction remains weak, and that affects the unemployment numbers and other things. So what do we expect in 2015? So GDP, we expect GDP to grow in a range of 2.6 to 2.9%. Unemployment rate to fall to about 5.5%. Inflation to remain below 2%, somewhere between sort of 1.75 and 2%, looking at the personal consumption expenditures inflation rate. And then we expect the Fed funds rate to rise, but still remain historically low. I mean, 1.25% is a very low federal funds rate. So we're still, providing stimulus to the economy. That's my spiel.
Thank you.
Hello. First of all, my thanks to the Walter Center and my friends in the Econ department for having me back again. It's always great fun to be here. I'm an odd sort of economist. I focus on local economies, neighborhoods, communities, regions. And so the kinds of things I look at and talk about are very different from what Ian and Joel talk about, although what they talk about informs what I talk about. But so expect something a little bit different. I have two quick agenda items that I want to share with you. First of all, I want to give you an employment status report for Central Ohio. And then I want to share a few thoughts specifically about Delaware County. Now, it looks like Central Ohio employment has hit a soft patch. The chart I have here shows employment growth locally, statewide, and nationally since the beginning of 2010, which was when employment started growing after the recession ended. The way that I've set this up is on an index basis, with everybody's January 2010 employment set to 100. So what this is showing you is cumulative percentage employment growth since January 2010. Now the overall picture, what you see here, the blue line on top is the Columbus Metropolitan Statistical Area, the purple line is Ohio, and the black line is the US. The overall picture here is very, very happy for Central Ohio. The Columbus metro area has added 89,000 jobs since January 2010, total growth since then of 10%. National employment growth has been 7.5%, Ohio's up 5.9%. But I want you to take a closer look at the right side of that chart. What that's showing is that the local trend and the statewide trend have both flattened. So far this year, if you average employment for the first 9 months of 2014 and you compare it to the first 9 months of 2013, what you get is a gain in U.S. employment of 1.8%, a gain in Ohio employment of 0.8%, and a gain in Central Ohio employment of 0.7%. Not very happy at all. And there are two major reasons why, and this is the first. This is showing you employment in professional and business services. This sector runs neck and neck with government as Central Ohio's largest sector. It accounts for about 160,000 of our 950,000 or so jobs. Central Ohio employment in this sector, in terms of concentration, is way above average. So this is really, really important for us. This sector includes all sorts of professional services that aren't medical in nature. So you have accountants here, you have architects and engineers, you have IT services, you have marketing, public relations, corporate offices, administrative support services, and waste services. As of a year ago, employment in this sector was up 23,000, 17% from January 2010. But as you see, this was a whole lot better than what the state was doing and the U.S. was doing. But since then, employment has slumped, and we've given back 5,600 of that 23,000 gain. Local growth is now underperforming the U.S., and it's even underperforming the state. So that's the first reason. Here's the second. This is finance and insurance, which accounts for 61,000 jobs, and it's also far more heavily concentrated in central Ohio than it is in other places. And as you see, this went straight up and then straight down. A year ago, we were up 13%, while the U.S. was up 2%, Ohio was up 4%. But since then, we've given back about 40% of that gain. So that's why these trends are looking so weak. However, this story may not be correct. This is a wonderful lesson for those of you who are studying economics. You should never bet your life on the truth of economic statistics. The numbers that I use for my analysis are what are called the current employment statistics. They come from the Bureau of Labor Statistics. They're the most timely numbers you can get on metro area employment. They hit the street about 3 weeks after the end of the month. Something you need to remember, though, about economic statistics is this. Reliable statistics aren't timely, and timely statistics aren't reliable. These stats, the current employment stats, are based on a very limited national sample, and they're brought down to the state level and the local level through the magic of econometric smoke and mirrors. And the sample rates for these two sectors, business services and finance and insurance, as well as for the private sector as a whole, are both even lower than the low sample rate for the economy as a whole. So these two sectors are even less reliable than the total economy is. More reliable estimates come in over the course of the year, and then the Bureau of Labor Statistics issues revisions of these employment stats for the past 2 years every March. And these corrections can add or subtract thousands of jobs and completely change the story at the sector level. The corrections have actually gotten bigger over time. Recent corrections have been in 10,000 jobs or more. And they've almost always been upward. And as it turns out, the fact that the trend broke last summer of 2013, is very significant, because the middle of the previous year is right when these statistics start getting really, really sketchy. And here's a different view. This shows you employment from the local area unemployment statistics. This measures the number of people who live in the region and work someplace. It's a different population and a different concept of employment, but you expect at least some level of consistency. And what do you see here? You do not see a break last summer. So the real upshot, the moral of the story is we really don't know yet. And we won't know until next March. I'm willing to bet that the trends that I showed you are probably pessimistic, although I've heard a couple anecdotal things that perhaps lead me to believe that this year, for a change, there may be a little tiny bit of fire to go with the smoke. But I'm going to look at that in much more detail over the coming weeks, because I am releasing my 16th annual Columbus Economic Forecast, as usual, at the Columbus Metropolitan Club this year on January 7th. And obviously, I have to have something halfway intelligent to say by then. And to say something halfway intelligent, I have to take into account both the trends that we see and the trends that might really be. So that's where the Central Ohio economy is. Let me give you a real quick view of Delaware County. The Delaware County Commissioners hired Regionomics to do a strategic economic development plan for the county. This plan was formally approved by the county commissioners on October 30th. The plan's going to be posted on the county website, I hope soon. Jenna Jackson is nodding, so it will be. And I'm also planning to post it on my website too. There is a 15-page summary of this plan, which you're welcome to read, but you get extra points if you read all 166 pages of the full plan. As usual, when you do this sort of thing, there's good news and there's some less good news. But fortunately, in the case of Delaware County, the good news far outweighs the less good news. So here is a real quick view of what I found. Population growth in Delaware County has been amazing, and it's going to continue to be amazing. Population in this county has tripled since 1980, and it's projected by the state to increase another 50% and reach 282,000 by 2040. However, population growth has slowed significantly over the last decade. We were getting this, in the early 2000s, we were getting about 6% growth per year, making Delaware County one of the fastest growing counties in the U.S. We're now running at about 2% per year. That's still far above the national and regional average. But the reason why population growth has slowed is that the net number of movers into the county, the movers in minus the movers out, that number has dropped big time, from about 6,000 a decade ago per year to about 2,000 now. Educational attainment is also amazing. 57% of adults in Delaware County hold a college degree. That compares to 39% of those in the region, 36% of adults nationally. Population is more heavily tilted towards younger age groups, so in coming years there's going to be a higher percentage of working age adults available to work and to support the young and the elderly who are not in the labor force. That has good implications both for workforce development and for the fiscal security of the county. One very troubling finding, though, is that the county's high housing values have led to a far greater number of homeowners in Delaware County spending a worryingly high share of their income on housing. That has potential destabilizing implications that we really don't want to think about. Employment more than doubled between 2001 and 2013, yielding a net increase of 41,000 jobs in the county, and the sole negative impact of the most severe recession since the 1930s was a net decline in 2009 of 140 jobs. That was it. Key sectors of the Delaware County economy are distribution, finance and insurance, IT, various manufacturing industries. But farming is extremely important in the county economy too, and the county downplays the importance of farming at its peril. Farming is one of the things that's driving this economy. I looked at small business development, and what I found was very similar to what I found in the region as a whole, which has me very worried. The formation of businesses in Delaware County is really strong, but these businesses transition to hiring employees far less often than they should. So the birth rate of employer businesses is very low. It's low region-wide, it's low throughout the Midwest, and it's something that we all need to be very, very worried about. Probably the biggest strength of Delaware County, though, is its quality of life and the wide range of community leaders whom I talk to who guard that quality of life very jealously. That bodes particularly well for your future. So that is what I wanted to share. Thank you.
Thank you, very insightful. I would like to ask our participants whether they have any questions about each other's presentations.
Ian, I'm curious about the...
Bill.
Oh, thank you. I am curious about the housing situation in China. There was a very worrying report on 60 Minutes a few months ago about the huge apartment buildings that are being built with nobody to live in them. And what do you think is going to be the impact? Is that part of the hard landing that you're talking about?
Absolutely. I mean, I think the decline in residential investment, part of that is driven by the concerns about that decline in residential investment is driven by the fact that China's had its own housing bubble. Of course, a lot of that bubble has been underwritten by different kind of financing to what we had here in the US. If you know anything about the Chinese financial system, that they actually have very few instruments through which they can lend or save. You have a lot of financial repression in China, and a lot of this lending was actually what was called curbside lending. And The Economist was warning about this 4 or 5 years ago, that this was sort of off the balance sheet, informal lending, which maybe in a sort of rural credit sense wouldn't be a bad thing, but as you say, we're talking about investment going into now empty housing block. When I just talked to one of our former graduate students who graduated over the summer, went back to Beijing to work in Renmin University, and she's telling me for all these empty apartment blocks, it's extremely difficult to find a reasonably priced apartment. So it's not obvious to me precisely what's going on in those city housing markets. My guess is a lot of this development was driven by local urban officials, urban party members, and of course a lot of this probably has land grabs going on and a certain amount of corruption, of course. So it's hard to tell, but I think they're heading for that hard landing on the residential side. That's right.
And what'll be the implication then for us?
For us here in the U.S., well, remember that. Let me give you a number. Over the past 20 years, imports from China by the US have increased by over 1,000%, and our exports have only increased by about 400%. So slowing down in Chinese economic growth, how's that going to impact the US? Maybe it's actually good for us if it starts to narrow the trade deficit further, but it's bad for income distribution in China, which is already very skewed, as you know, between the coast and the inland areas. urban and suburban, rural and suburban. So the hard landing, I think, is going to affect countries like Africa more than it's going to affect the US, because I was talking to Doug Southgate earlier over a glass of wine. He had 2 glasses of wine, I had 1 beer. In fact, I forgot my usual rule, which is when I come to give an Outlook talk up here at Wesleyan, I always try to remember not to have a drink before I get up here. So maybe I should have had 2.
Yeah.
Oh, I was sniffing from a little flask when nobody... 50% of Africa's exports go to China, predominantly in basic commodities. So, and as you know, China is investing heavily in commodity production, all the basic commodities, zinc, copper, etc. And I think if China's sovereign wealth fund gets damaged by a hard landing, I think the knock-on effect would be pretty large on a country like Africa and countries like Australia, who export a lot of coal and other commodities to China, but perhaps less so the US, given our trade imbalance with China.
Well, I have a question for Joe. You mentioned that housing prices have done well, but starts have not. If I would teach my students economic theory, I would say, well, prices going up would drive higher quantity supplied. Why are we not seeing that? Would you know?
So it could, right, with some delay, that you'd have enough demand to push the starts. What we know is that there's still the stock of housing that was built, pre-2008, that isn't all absorbed. So that's one piece of the reason we see lower starts. Part of the reason we're seeing these price increases is essentially the foreclosure crisis, or the foreclosure of homes, has driven a lot of the housing price indexes down, and those impacts took a long time to play out as banks essentially put houses on their asset books, foreclosed, held houses, and didn't sell them. As they sell them slowly, they're tending to be sold below market, and that pulls housing price indexes down. So one of the questions is, how much is the recent increase in house prices sort of a real increase where demand is driving price up, and how much is it just sort of burning through the foreclosure stock, and that we've burned through most of the foreclosure stock. So that's the reason we might not see that immediate impact on starts. The other piece is, if you talk to builders, there's plenty of builders who would like to go back to work and build single-family homes, but they're not finding financing from banks for those projects. Banks are very hesitant still to build single-family homes on spec, meaning you build the home and find a buyer after you build it or while you're building it, because they got burned quite severely with the last housing bubble.
I had a question for Bill, and I had a question for Joel. Bill, you talked about the fast rate of population growth, and you seem very positive about the tax base. What's Delaware's infrastructure look like, and Delaware County's infrastructure look like, and are the taxpayers willing to put the necessary monies into developing, rebuilding, expanding that infrastructure? What's the appetite for spending on public goods in Delaware County?
You've actually hit a hot button. Maybe we should order in breakfast.
The short answer.
I am extremely concerned about the tax base in general and how it, over the longer run, not just in Delaware County, but really throughout Ohio. I just collaborated recently with the Center for Community Solutions, which is a Cleveland-based think tank, on the long-run implications of the aging Ohio population for tax collections. My part was doing sales tax, and it goes like this for a little while, and then it goes like that. And the reason why it goes like that is that older households spend less than younger households do. And a lot of what they spend is on health care, and much of health care is not taxable. So you've got a problem with counties then, whose bread and butter is sales tax collections. You've got a problem with municipalities whose bread and butter is payroll tax collections because of this declining participation rate, which the Bureau of Labor Statistics predicts to continue to decline. And that's one of the things I said about Delaware County. The balance here of younger versus older people is a little bit better than average, so that rate goes up for a little while, maybe to about 2020, 2025, something like that. Region-wide, statewide, it's going down right now, the share of workers to non-workers. And that hits municipalities whose income tax collections are less. The only positive thing in that is that property values may stay stable or go up, and that is good for school districts. But the real problem that we have in Ohio, and this is going to take some legislative action to fix, is that the sources of revenue are not diversified. And they're not diversified by statute, and that is going to really bite us in a few years. That's something I'm really worried about. So spending on infrastructure, I guess when 71 turns into a parking lot, people will want to spend on infrastructure. But let us hope that it doesn't get to that point. One problem with Delaware County is that we've got really good connectivity north and south. We do not have good connectivity east and west. And that's something I highlighted in my report.
And I had a question for Joel. The jury's probably still out on precisely the effect of quantitative easing, which is what the Federal Reserve has been doing for the last 4 or 5 years, I guess. Yeah. I saw an article out in Economic Policy recently that actually has some numbers on what they think might have been the impact on various rates and risk premia and so on. Now, given that the Fed one of its jobs is to target unemployment, but it has no instrument that directly affects unemployment. I mean, their only real instrument is the rate of interest and their balance sheet, which is, we used to call it printing money or expanding the money supply. So what's if quantitative easing has worked, so let's assume that the rate of unemployment has come down, you've targeted reducing it, and that's as a result of quantitative easing. Through what mechanism has that actually worked, or what do you think is the mechanism through which it's worked? Because there's a lot of debate about, it's just alchemy, or it's all gone into stock price volatility, or whatever. So what's your feeling on that?
So, this is definitely still an issue of debate within the Federal Reserve System too, in terms of what is the impact of quantitative easing. Would we do it again? Our take on it was that we were faced with a recession that without substantial action would be on par with the Great Depression. And so we essentially had to use every gun in the arsenal. And so that's the motivation. The question is how many hits did we get with that gun? It's a good question. But what our sense is that what quantitative easing allowed us to impact that would be difficult with other tools is the long-term interest rate. The Fed funds rate is a very short-term interest rate, and it's difficult to translate that into long-term interest rate changes. But if you want to push residential investment, you want to push business investment, the long-term interest rate is very important. And our sense was that quantitative easing was our best tool for impacting, say, that 10-year Treasury rate or longer-term interest rates. And on that front, we feel like there was some impact on the long-term interest rate. How much that translated in unemployment reduction, we don't have a good handle on that. But the lever we were really trying to hit with quantitative easing was long-term interest rates, and you see that they came down and stayed down.
But do you think, so just one follow-up question, and Goran wants to go to the audience, but if I understand the argument correctly, you had to try to change people's expectations about the way the central bank would deal with inflation. And I hate to quote Krugman, because most people think of him as a New York Times editorial writer, but he was actually a pretty good economist once upon a time.
And an excellent regional economist, too.
I mean, he was one of my heroes. He was a trade economist, and that's why he won the Nobel Prize. But he talked back in the late 90s when Japan was going through very much a deflationary period. He talked about the need to use monetary policy to, to the central bank should credibly pre-commit to being irresponsible. By that, the idea is that you get people to change their expectations about when the central bank's going to step in to start raise interest rates. So, I mean, maybe you don't have an answer for this, but have you been irresponsible enough?
We like to think that we've been highly responsible. Look, 20 years ago, the Federal Reserve System had an internal debate, and there was actually some public debate, and this is actually where sort of Janet Yellen really rose to prominence, was this debate about should we have a 0 target on the inflation rate versus the 2% target. It's going to be hard to get us to move up past 2%. And so that's not directly answering your question about recklessness, but it's just with, within the Federal Reserve, we still have people who believe that that 2% target is too risky. They want, there's people who wanted to pull off the pedal off the gas over a year ago. And so, I think we did as much as we could internally to do for the economy. But like I say, I mean, you even look back 20 years ago, the debate is about 0% to 2%. So saying 2% is it going forward, that's pretty good. And there's also a significant minority of voices within the Federal Reserve that say it's okay for us to go past 2% for a few years to continue to improve the employment outlook. But that case has been weakened by unemployment falling down now, almost pretty close to what people consider the long-term natural rate. And I wanted to pick up, you were asking about sort of what's the impact of China. Well, one of the key connections between the Chinese economy and our economy is commodities markets. So when they're competing for commodities and we're competing for commodities, coming into, in 2007, early 2008, we had substantial, higher than typical inflation rates, a lot of it driven from the commodity side. And that was a period where China, India were investing heavily, and we were also investing heavily in our housing stock, and it created a lot of demand for commodities. So when we see a place like China having a weak economy, that actually reduces inflation expectations in our economy because that's less competition for those commodities, copper, gypsum, all these other things that we compete with them for. So to me, that's actually one of the really important links between the two.
Except it's probably pretty bad for Ohio farmers, given the amount of soybeans we export to China. So
Yeah.
Yes.
Thank you, and I'd like to invite the audience if they have any questions. And if you do have a question, please raise your hand and somebody will bring you a microphone because we are videotaping that. So, and the rest of the audience can hear you.
I think this is particularly for Joel. Do you think that the government will help with student loan debt in the future and trying to reduce that pressure with students going forward with the large quantity of debt?
Short answer is I don't know. One really important thing that I think gets lost in the discussion about student loan debt is people tend to focus on the balances as opposed to the payments. And when you compare student loan debt to other sources of debt, the payments are actually fairly small given the size of the balance. One, because the interest rates are relatively low, and two, because they're given extraordinary, sort of unusually long payback periods. That's sort of what student loan debt is built to be, is a way for you to borrow early on and pay over a long period of time. So while there has been substantial growth in student loan debt, when you actually look at sort of what that means when people get a job and have to start making their payments, for many people those payments remain manageable. So I don't personally see, this is just me speaking as Joel Elvery, not as a member of the Federal Reserve Bank of Cleveland, I don't see it likely that there would be sufficient political pressure to create that kind of intervention on student loan debt. Now, where you might see that kind of political pressure is, and we've seen some changes on the regulations for proprietary schools, where there's been a fair amount of evidence, essentially predatory lending for student loans. And it's completely reasonable to expect more regulation on that front, I think, where they'll try to limit access to the federal student loan pool of proprietary schools. But it's hard to write good regs on that.
We had a question over there.
You need
Yes, you do.
Well, my question is, if they already know that the housing market is sluggish, why would they want to attempt to increase the interest rates in home buying? I mean, why can't they do a rollback again for another year or two and have the 30-year fixed at 3%? I mean, I don't understand that.
Assume that's for me, huh? All right. So,
Whoever.
Short straw.
so there's sort of, we have to balance two issues, right? On the one side, keeping inflation low. On the other side, pushing up or reducing the unemployment rate or keeping it at a historical low. We're seeing unemployment rate rapidly reaching what we consider sort of the natural rate of unemployment. So the pressure to increase stimulus on that side is low. But the other piece is, right now, projections look good, GDP growth looks good going forward. But if let's say 2 years from now, there's another recession, there's some fiscal crisis, there's spillover from the euro economies on our economy, the Federal Reserve System's one sort of most effective tool is that federal funds rate. We essentially have to be thinking about getting that federal funds rate back up so that if something comes down the road, we can respond. If the federal funds rate's at 1% or at 2.25%, we don't have much ammunition if something unexpected comes down the road. So we have to get that rate, we have to think sort of long-term and get that rate back to a place where we have ammunition if there's some sort of economic crisis in the future.
But is there a risk as you back off quantitative easing, right? So what you were doing was buying long-term bonds, and the objective, drive up bond prices, drive down, I mean, why would anybody bother to buy 30-year bonds right now? I mean, yields have probably actually been virtually negative. Mm-hmm. So if that is there a risk that rolling back quantitative easing will push up this 30-year rate a little bit too quickly and stifle any growth in the? I understand the argument about keeping down inflation because we're hitting the natural rate of unemployment, but do you run the risk of stifling, the signs of growth in the housing market because the term structure rises?
Sure, I understand what you're saying. So, what we can see is that mortgage rates continue to be relatively low, and there's part of the reason for having a low 30-year rate, things like that, is to push investment into sort of productive things that will lead to immediate investment as opposed to something like the 30-year bond, which has less. And again, if the sense is that we need less stimulus, we don't need to push people into productive investment. We can let them sort of choose their financial instruments better.
Right here. I think that's for you. Probably.
It's called the dismal science for a reason. And you've given us, in particular, Ian and Joel, you've surveyed the macroeconomic policy landscape, chiefly the monetary policy landscape, and leaving me with the impression there are not a whole lot of options out there. But I was just wondering if you could broaden out and talk about other areas of policy, not so much fiscal policy, but getting down to sectoral levels. There was a good financial survey, a survey of the financial sector in The Economist magazine, in which the point was made that our financial policy in this country, the latest edition of which is the Dodd-Frank bill, our policy is the legacy of past crises, with the federal government responding often in inappropriate ways, but permanent ways to each crisis, and the Dodd-Frank arguably is another chapter in that history. There's the Affordable Care Act with its arguable impact on employment. Certain things that we could be doing more in the energy sector. I guess I'm saying in part, let's look at sectoral policies that affect supply side performance and so forth, because it seems that just simplifying somewhat your message, we're sort of at, this is an exaggeration. We're close to the end of the road. There are not too many options. For example, Ian, we take what you're saying that we need a substantially negative real interest rate to get the proper stimulus on the investment side. Well, we're not going to get there for various reasons. So why not think about some of these other policy issues and back off from the fixation on macroeconomic monetary policy and so forth, if that makes sense.
Was there a question there? So Doug's my colleague. So, the problem with sectoral level policy. I mean, I come from Britain, where our sectoral level policy prior to Mrs. Thatcher coming to power was I remember this as an undergrad. We spent our time supporting lame ducks and trying to figure out who we should target government spending towards. And there was always this argument that you run the risk of crowding out private investment and entrepreneurship. And as I've studied international trade, of course, I understand very well the idea of rent-seeking behavior. And that's what always troubles me about sectoral level policy is who's going to decide on which sectors? And once the policies are put in place, do you get hysteresis in the sense that those policies stay there, irrespective of whether they're working properly or not, and we get people running around Capitol Hill with their lawyers lobbying to keep policies in place? I mean, without picking on any sector in particular, it seems that the problem, unless you can target it right at the right sectors and remove that policy when the sector either no longer leads the policy or it really is a dead duck as opposed to just the parrot. Going back to my parrot analogy, the parrot really is lying on the bottom of the cage dead. I mean, government policy, at least in the trade area, seems to be about loss aversion, right? When industry is large enough and starts to make losses, we see a lot of protection. As soon as it's close to dying, you back off the protection, and the lobbying goes on to try to maintain that level of support and protection. You're talking about targeting dynamic sectors, Doug, I guess.
No, I guess I'm talking about Hippocratic oath. Stop doing damage in these various sectors.
Okay, well, I guess we're on the same page then.
Yeah, definitely.
Yeah.
As always, Leanne.
Oh, yeah, right.
I think we've done damage to the financial sector, the medical sector, and on and on and on. There are a lot of distortions out there.
I mean, I go back to the arguments about secular stagnation on the fiscal side. They're not on the demand and investment side. They're not just talking about government spending. There's a lot of discussion about relaxing labor market regulations, et cetera, particularly in the European Union, where you have much stronger trade unions, you have much longer standing restrictions in labor markets, so you get a lot less wage flexibility, a lot less, mobilities are actually really pretty poor in Europe. If you read what the regional and urban economists talk about, although, of course, a lot more people have been emigrating from Spain in the last few years, and mostly going to Germany, too. I think the most successful industry in Spain has been German language classes, or German language schools, actually. There was another question over here, I believe. And there's one over there. That lady back there in the glasses.
Yeah, I think this is for Joel again. You mentioned about wage growth wasn't as strong. Well, if you have a lot of younger people today that have high student debt, even when they come out of school, wages are low. How do they think that they can balance this all out? I mean, as far as them being able to spend, to afford a home, everything just seems so contradictory. And I also hear that a lot of corporations have made a great deal of money, but they're holding back on hiring, they're holding back on providing raises to people who, deserve it. So I don't know, it just seems there's something wrong, big time. And I feel like I'm in the Wizard of Oz, behind that curtain. Everybody's, I don't know, something doesn't seem right.
Yeah, I mean, I understand your frustration. I guess a couple things that I want to comment on there. So when we talk about wages being flat, that means that wages aren't growing, but, someone coming out of college and getting a job, they're still going to be getting substantially more wages than if they hadn't gone to college. Generally, now there will be some who don't, but generally they will. And so that's how you would anticipate that they're going to pay for student loans. And the research still shows that investment in a college education, even if you finance all of it with a student loan, you're still better off. The last estimate I saw was over your lifetime, approximately $500,000 better off from financing an entire college education. So on that side, I think it's a concern. We obviously everyone would like to see more wage growth, but in terms of the decision about do you invest in college or not, the real core issue is comparing your wages to what they would be without a college degree, and it's still substantially better. And then as far as the question about why are firms sort of recording record profits but not increasing wages? Well, we have had a relatively weak labor market. There hasn't been pressure for them to increase wages. They're able to hire skilled workers that they want without having to increase wages. It's pretty straightforward. But the other piece, when I sit back and look for something to worry about in our economy, the piece that really concerns me is a lot of profits are coming from sort of process improvements and productivity gains as opposed to product improvements. And why does this matter? This matters because when you're talking about process and productivity improvements, that means you can produce the same output with fewer workers. But it doesn't say anything about the demand for your output growing. And so you get profit gains from essentially doing what you sort of, from the outside, it looks like you're doing what you always used to do. You're selling, 60 million widgets or something, right? But then you need fewer inputs in order to do that, and so that's where the profit gain comes from. A product gain, as opposed to a productivity gain, is you produce some sort of product innovation that gets more people to shell out cash. And if we think over the last 10 years, what have we seen that does that? It's really smartphones, right? Mm-hmm. But there's not much beyond smartphones where there's been some sort of new product or new innovation that really drives people to open up their wallets. And it's not like smartphones have sort of suppressed spending that would have occurred otherwise in landlines and in other types of cell phones. So that's sort of the thing that keeps me up at night is what can we do to have sort of process innovation is valuable, but what really drives wage gain and sort of long-term growth is product innovation, and that's an open question.
One brief question, and then we'll have to wrap it up. Over there.
So I know you mentioned a little bit about the dying or dead bird of Europe. What will happen if the euro collapses, or if what will be the impact on the U.S. if the bird is actually dead and that area falls apart? What will be the fallout of that, or is it going that way? So.
Well, I still don't believe the Eurozone's going to collapse. I think the cost of, the estimates all show if you did allow the Eurozone to collapse, the GDP costs would be huge compared to the cost of actually bailing out the Eurozone. I mean, the estimates were done when, and in fact, the Eurozone has been stabilized in terms of currency, and that's because the European Central Bank was able to do its job as the lender of last resort. Mario Draghi came in and said, I will do everything it takes to prop up bonds in the Eurozone exactly as a normal central bank would do. And it's really interesting if you look, and this is what I talked about here maybe 2 or 3 years ago. Dragan was reminding me of this earlier, that Goran, sorry, was reminding me of this earlier over dinner, that the macro experts who think about these things, I mean, the fundamental problem with Europe was when you joined the Eurozone, you gave up monetary policy. You could no longer issue a currency. So you could no longer affect bond prices, and hence the rate at which you as a government had to borrow in international markets. And this is a bit like developing countries who put themselves on the dollar. You always suffer the potential of a sudden stop in liquidity. And that meant that the central bank's function had to shift to the European Central Bank. And all the time the European Central Bank focuses on a very narrow objective of just inflation and not acting as, because the Fed did this. They acted as the lender of last resort during the financial crisis, and so did the Bank of England. And in fact, if you look at the data, Britain had a higher debt to GDP ratio and better bond and better and lower yields on their bonds, i.e. they were less risky than Spain, which had lower debt to GDP at the onset of the Eurozone crisis. So the problem in Europe right now is the pressure being placed through the austerity measures, I think, are probably too tight. And I think the social issues they're facing in Greece, I mean, this growing up of, this has happened in Britain, which is not in the Eurozone, but it's still part of the European economic area, is this growth of, how shall I say, populist right-wing groups that are very anti-immigrant, et cetera, are causing, I think it's social cohesion in Europe that's sort of somewhat worrying right now. So I don't think the Eurozone will collapse, because I think the central bank will do its job of stepping in if there's another bond crisis. But who knows? Maybe the parrot will be dead. Maybe it's already dead. Who knows?
Well, thank to all three participants. From Ian, I learned that inflation needs to increase to bring down the interest rates. Right? Something that really to get us out of a financial crisis, remnants of the financial crisis. So the financial system causes a crisis, pushes the real economy in trouble. We need to get it going by lowering interest rates, but that might be incompatible with a sound financial system. So I guess we are in for another run there. Joel, you mentioned refinance soon. Remember, if you're going to refinance, call your banker tomorrow. Fed needs ammunition, but it's going to be responsible with it. Right? And then Bill, you talked about quality of life in Delaware. That's good to hear, since I live in Delaware, and spending on infrastructure is needed. How about spending on the quieting train passes, railroad crossings to make them a little more quiet? Increases both quality of life and infrastructure spending.
True.
Well, I would like to thank the audience for a wonderful evening, and thank our three participants, and I hope to see them back again.